Take $200,000 and spread it across 5 Fidelity Index funds. Build it one way and you get paid more than $6,000 a month for the rest of your life without ever selling a single share. Build it another way, same $200,000, same 5 funds, and that money grows into nearly $13 million. Today we are walking through both versions completely, showing you the 5 funds, what each one does, how the weighting changes everything, and which version makes more sense depending on what you actually need your money to do. Quick disclaimer before anything else: nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely educational. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start with the 5 funds, because understanding what each one does is the foundation for understanding why the weighting decisions matter so much. Every portfolio worth building has a set of jobs that need to be filled. You need something to anchor at a stable, broad foundation that keeps the whole thing grounded. You need something to grow at fast, concentrated exposure to the companies that have been generating the strongest returns. You need something reaching for the companies that have not made it, yet the small, early-stage businesses that could become the giants of the next decade. You need something generating real income, a meaningful yield that actually pays you while you hold. And you need something betting on the parts of the world outside the United States, because no single country leads the global economy forever, and a portfolio that depends entirely on one country working out well every decade is taking a concentration risk that most investors do not fully appreciate. 5 jobs, 5 funds, let's go through them. The anchor is FXAIX, the Fidelity 500 Index Fund. This tracks the S&P 500 of the largest American companies held in proportion to their market size. When you hear that the market was up or down today, this is basically what people mean. The names inside are exactly what you would expect: Nvidia, Apple, Microsoft, Amazon, Meta. The fund leans heavily toward technology, with over a third of its weight there, and it runs at a 1.06% dividend yield, a 6.84% annual dividend growth rate, and approximately 13.54% annual share price appreciation historically. This is the floor you build everything else on. There's not much to debate about FXAIX. It is simply the standard starting point for any serious long-term portfolio. The growth engine is FNCMX, the Fidelity Nasdaq Composite Index Fund. This tracks the Nasdaq Composite, roughly 3,000 companies, but heavily concentrated in technology in a way that goes well beyond what you get in the S&P 500. While FXAIX owns Nvidia at a weight proportional to its share of the overall market, FNCMX has Nvidia at over 11% of the entire fund on its own. The top 10 holdings make up nearly 59% of the whole thing. You are not really getting exposure to 3,000 companies spread evenly. You are making a concentrated bet on the largest technology companies in the world, with a long tail of smaller names trailing behind them. The payoff for accepting that concentration is the performance number, approximately 17.95% annual share price appreciation, the highest of any fund we are examining today. The flip side is equally straightforward. When large-cap technology takes a meaningful hit, this is the fund that feels it first and most severely. It comes in at a 0.47% dividend yield and a 6.91% dividend growth rate. The wildcard is FSSNX, the Fidelity Small Cap Index Fund. This tracks the Russell 2000, which is approximately 2,000 small American companies, businesses too small to qualify for the S&P 500. The top 10 holdings of FSSNX add up to under 6% of the entire fund. No single company meaningfully moves the needle. It is 2,000 small bets spread thin across the American economy. The logic is simple. Every company inside FXAIX was a tiny company at some point, and this is the bet that a handful of the names inside FSSNX become the giants of the next 30 years. The honest caveat on this one is that the track record does not match that narrative recently. FSSNX has run at approximately 9.6% annual share price appreciation, the lowest of the 5 funds, because small-cap stocks have genuinely trailed large-cap stocks for an extended period. The 0.89% dividend yield and 7.44% dividend growth rate do not make up for that underperformance in total return terms. The reason to hold it is not because the numbers are the best, they are not, but because it is the only fund in this group that reaches the early-stage American economy that the other 4 cannot access. It is a deliberate bet held with open eyes about its recent track record. The income anchor is FSPSX, the Fidelity International Index Fund. This tracks the MSCI EAFE index developed economies outside the United States, primarily Japan, the United Kingdom, Germany, Switzerland, and Australia. The names inside include Nestle, Roche, AstraZeneca, HSBC, and ASML, the Dutch company that builds the only machines advanced enough to manufacture modern computer chips at scale. ASML does not make chips itself. It makes the equipment that makes chip manufacturing possible, which makes it one of the most structurally important companies in the global economy. FSPSX does two things in this portfolio. It generates the highest income of any fund in the group at a 5.8% dividend yield, more than triple the next highest yielder, and it provides insurance against the United States having a rough period, because international developed markets do not move in lockstep with American equities. The trade-off is growth. At approximately 7% annual share price appreciation, FSPSX is the slowest grower of the five. That tension best income, weakest price growth is the central decision point in how you weight this fund, and it is what drives the difference between the two portfolio constructions we will build shortly. The long shot is FPADX, the Fidelity Emerging Markets Index Fund. Emerging markets means economies that are still growing into their full-size: Taiwan, South Korea, China, India, with approximately 80% of this fund sitting in Asia. Taiwan Semiconductor Manufacturing Company, the company that actually fabricates the advanced chips designed by NVIDIA and others, is over 14% of the entire fund on its own. After that, Samsung, SK Hynix, Tencent, Alibaba. What is striking is that chip manufacturers keep appearing at the center of every corner of this portfolio. NVIDIA anchors the American funds. ASML anchors the European Fund. TSMC anchors the Emerging Markets Fund. The entire modern global economy is running on semiconductors in a way that cuts across every geography and every investment category. FPADX comes in at a 1.91% dividend yield and 7.71% annual share price appreciation, both modest. But the standout number is the 11.01% annual dividend growth rate, the highest of all five funds. It has been one of the worst performing parts of the market for nearly a decade, and it has the fastest growing dividend of any fund here. Both of those are true simultaneously. That is the five: an anchor, an engine, a wildcard, an income foundation, and a long shot. Now comes the part that actually changes everything: how much of each one you buy. The weighting decision is the entire strategy. The same five funds built with different weights produce outcomes that look almost nothing alike over 30 years. Let's build the first version. The dividend-tilted portfolio is designed to pay you to generate maximum monthly income from the five funds while still giving the account a chance to grow over time. Here is how the $200,000 splits: 35% into FSPSX, the international fund, which is $70,000. This gets the largest allocation because it is the one actually writing the income checks. That 5.8% yield is what lands in the account as cash. 20% into FPADX, Emerging Markets, which is $40,000 sized meaningfully because its 11% dividend growth rate is what makes the monthly check grow over time. 20% into FXAIX, the S&P 500, another $40,000, keeping quality American large-cap exposure as the anchor. 15% into FNCMX, the growth engine, at $30,000 because even an income portfolio needs real growth so the account does not stall. And 10% into FSSNX, the small-cap wildcard, at $20,000, the smallest slice, because in a portfolio designed to pay you, the most speculative position stays small. Notice the overall geography. The American funds together total 45% of the portfolio, while the two international funds account for 55%. This is not pessimism about the United States, it is letting the higher-yielding side of the world take the lead while keeping nearly half the money in American companies. The blended characteristics of this dividend-tilted portfolio come out to a 2.78% current yield, a 7.75% dividend growth rate, and approximately 10.35% annual appreciation. Run those numbers forward 30 years with dividends reinvested, and the projections show the account reaching approximately $6.49 million by year 30, generating approximately $75,282 in annual dividends at that point, which works out to approximately $6,273 per month, arriving without selling a single share. Along the way, after 10 years, the account is projected to reach roughly $669,000, and after 20 years, approximately $2.1 million. Of the total growth projected over 30 years, approximately $5.45 million comes from share price appreciation, and roughly $839,000 comes from reinvested dividends compounding over time. The critical distinction of the dividend approach is what the $6,273 monthly check actually is. It is dividends being paid out while every share stays invested. The account does not shrink to generate it. The principal is untouched. The money simply arrives because John owns shares in companies and funds that pay him for doing so. The account keeps growing even as it pays him. Now let's build the other version. The growth-tilted portfolio takes the same five funds and flips the weights almost entirely. 50% into FNCMX, the growth engine, which is $100,000. That 17.95% annual appreciation is the highest number in the group, and this construction leans on it as hard as possible. 25% into FXAIX, the S&P 500, which is $50,000 a bigger anchor this time to add more steady large-cap growth. 10% into FSSNX, small caps at $20,000. $10% into FPADX, emerging markets at $20,000. And FSPSX, the international income fund that was the largest single holding in the dividend portfolio at 35% drops to just 5% or $10,000. At that weight, it is not paying the bills anymore. It is just a small insurance policy against the United States having a bad stretch. What happened to the international allocation is the clearest illustration of the difference between these two philosophies. In the income build, international funds were 55% of the portfolio. In the growth build, they are 15%. They essentially swapped seats with the American growth names. The growth portfolio is approximately 85% American and built almost entirely to appreciate rather than to pay. The blended characteristics of the growth portfolio come out to a 1.07% current yield, a 7.35% dividend growth rate, and approximately 14.44% annual appreciation. That appreciation number is what does almost all the work over 30 years. The projections show the account reaching approximately $825,000 after 10 years, already meaningfully ahead of the income portfolio's $669,000 at the same mark. By year 20, approximately $3.29 million versus $2.1 million for the income build. And by year 30, approximately $12.86 million, nearly $13 million from the same $200,000. Of the total growth projected over 30 years, approximately $12.47 million comes from share price appreciation, and only roughly $197,000 from dividends, nearly 98% pure price growth. By year 30, this portfolio is projected to pay approximately $14,244 annually in dividends, which is $1,187 per month. The account grew to almost twice the size and pays almost 6 times less per month in income. That gap is the central tension in this entire analysis, and it is worth sitting with before drawing conclusions. The growth portfolio produces a dramatically larger account, $12.86 million versus $6.49 million, and there is a legitimate way to generate substantial income from that larger account through what is called the 4% rule. The Standard Retirement Guideline suggests that withdrawing approximately 4% of your portfolio annually should allow the account to last indefinitely. 4% of $12.86 million is approximately $514,000 per year, roughly $42,874 per month. That is nearly 7 times the income portfolio's $6,273, which seems to completely dominate the income approach on the income metric as well. But there is a structural difference that the 4% calculation obscures. Generating $42,874 per month from the growth portfolio requires selling shares every year. John is steadily reducing his position to pay himself. In good years, that feels fine. The account is growing faster than he is drawing it down. But in the year he retires and the market happens to be down 30%, he is selling shares at the bottom to cover his living expenses, permanently locking in losses on capital he can never recover. This is called sequence of returns risk, and it is one of the primary reasons people retire with large accounts and still end up running short. The timing of market returns matters enormously when you are drawing down a portfolio. The dividend portfolio does not have this problem. The $6,273 monthly check arrives whether the market is up 20% or down 30%. The dividends from the underlying funds are paid based on the company's earnings and distribution policies, not on the account's current market value. John does not need to sell anything. He does not need the market to cooperate on any particular year. The income is structurally independent of price volatility in a way that the 4% withdrawal strategy is not. So which version is actually better? The honest answer is that they are not competing for the same goal. The growth portfolio makes the account larger and can theoretically produce more spendable income in retirement, but it requires selling, which creates timing risk, and it requires the discipline to sell consistently through bear markets without panic. The dividend portfolio produces a smaller account but a structurally reliable income stream that never requires a sell decision and never depends on market timing to function. One is a bigger pile you gradually take apart over time. The other is a monthly check that arrives while the entire account stays intact and continues growing. The right choice depends entirely on what you actually need. If your goal is maximum wealth accumulation and you are comfortable managing withdrawals and living with the sequence of returns exposure that comes with it, the growth build is the more powerful tool over a 30-year horizon. If your goal is income that arrives predictably without requiring you to make sell decisions at potentially the worst possible moments, the dividend build is structurally better suited to that need, even though the final account value is lower. Both outcomes start from the same $200,000, both use the same 5 funds, the weighting is the entire difference. At Dividend Desk, this is the kind of framework analysis we bring you every week, the honest look at trade-offs, the complete picture of what different approaches actually produce, and the tools to make your own informed decision. If you found this breakdown useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community link in the description where we track investments, portfolio strategy, and income planning in real time. This is Dividend Desk. We will see you in the next one.